We're getting ready here. My name's Michael Corcelli. I'm the founder and Chief Investment Officer of Alexander Alternative Capital in Miami. A global asset manager, focuses on top-down macroeconomic trends, marrying that very nicely with bottom-up fundamental Benjamin Graham style investing. Thank you for tuning in live today. Today's my favorite time of the day, the favorite time of the month for macroeconomics. This is Macroeconomic Friday. Non Farm Payrolls coming out here in less than 1 minute. So thank you very much for tuning in live. Let's do a quick rundown of the equity and bond markets so we can set a baseline. See the treasuries right here have been very volatile this morning. Oh my God, there's a 255,000 jobs created in the month of July. Payrolls rise. This is a very, very strong number. We were calling for 180,000 jobs according to the survey, but as you can see here in the red, there's 255,000 jobs that were created. That's a very, very, very strong number. Let's dig in a little deeper. Let's see here. Private payrolls came in at 217,000 jobs created. Manufacturing payroll stronger than the 4,000 estimate. Unemployment rate moved up a little bit. That's because the size of the labor force actually grew. So labor force participation rate looks like it went up. That's a good sign. Average hourly earnings showing some wage inflation. That's going to put the Fed right back in play on a rate increase. Let's see here. Change in household employment. 420 labor force participation rate. Yeah, see that? See it moved up a little bit. Underemployment rate also moved up a little bit. Let's take a look at world bonds and how this is actually moving. World bonds this morning. We're gonna move into the U.S. Treasuries. Those are the most liquid market. As you can see here in the red, there's a sharp move. There's a sell-off in Treasuries. I'm actually very, very surprised here. The number is much stronger than expected. This is actually negating the weak rates that we had in April and May. It was an anomaly. The June report came in stronger than anyone expected, and now we have another strong number. This has definitely got the Fed back in play, back in focus. Economy's much stronger than most people expected. See the prices here? Immediate reaction of bond prices, a sell-off. This is going to be a very, very strong sell-off in bonds all day today. That's the 2-year. This is the 3-year. Same thing. 5-year. Same thing. Here comes the 10. This is the 10-year. No, this is the 8-year. 7 years. 7-year sell-off. Here's the 10-year. And last but not least, is the 10-year. Major sell-off. And last but not least, the 30-year. Another major sell-off. Let's take a look at some of the commodities, see how some of these commodities are actually reacting. Here's crude oil. Crude oil got a little bit of a bid up on the news, but it's still negative. I would expect the dollar to be strong. Let's check out the dollar index just to see what's happening in the dollar index. Hold on 1 second here. DXY. This is a delayed quote, so I can't even show you that until for another 7 minutes, the initial reaction. But there's other places that we can look for this data that it's not delayed. We can actually look. Let's see here. I'll just start dragging currencies in there. All right. So see the drop. That's versus the euro. This is versus the Japanese yen. Japanese yen, you get a very sharp spike up. Here's the British pound. Actually, the spike up is weakness in yen. See the pound? Pound's taking a beating. The dollar's beast on this macroeconomic indicator. We would expect more of the same here. So what does this mean? This means that anybody who's been weak and bearish on macroeconomic data coming out and just being really slow and pathetic, this has to call that into question. So you're looking at somebody who's been pounding the drum that the macroeconomic data is really, really weak, and it's been really, really weak. Well, guess what? We've had two very, very good numbers, and I have to go with job creation. I have to factor this in. I'm going to take the weekend, really look at what was going on, and this number is a big number. It's a strong number. It's a number that's stronger than the estimates that are out there. 250. If you're just tuning in now, 255,000 jobs. That is a very, very strong, strong number. The survey was only calling for 180,000 jobs. We also look at revisions from June. Revisions weren't lower; they were actually revisions higher. So all around, this is a positive economic data point. It's the absolute most important macroeconomic indicator out there. The U.S. job market is healthy, and employers are hiring. This is a robust number. This is a number that shows GDP growth acceleration. This is not the story of the first half of the U.S. The data coming out in the first half of 2016, both the slow-moving macroeconomic factors as well as the fast-moving macroeconomic factors, it was very, very pathetic. But the job market in the U.S. was very, very strong. And I can't help but go back to something that my grandfather taught me. Mike, if the job creation is slow, the economy is going to be slow. So until this economy starts creating jobs at a good pace, I'm not buying. So you gotta take this into consideration. He was right. He had a very successful career in real estate investing. He was a small business entrepreneur that worked his butt off to build a very, very successful life for our family. People around the world, from small business owners to the C-level executives in corporate America, follow this non-farm payroll job, the non-farm payrolls, the unemployment rate, to decide whether or not it's a good time to invest in expanding their businesses, or it's a good time to start laying people off, tightening up the purse strings, and bunkering down for the coming recession. This number pushes off GDP contraction in the U.S. It'll also start showing up in the accelerating, like fast moving, high frequency macroeconomic indicators that come out on a weekly basis. It'll start pushing these numbers up. It was a robust report today, and for anybody that's tuning in again, the number came in at 255,000 jobs versus 180,000 jobs is what the survey was calling for. And we have a 75,000 job beat. Last month, the numbers were revised upward, and it was all over the board, more jobs created than expected. So now, with that said, let's get into a little bit of the wage inflation. I'm going to pull up here some of the wage inflation, and I'll explain to you why wage inflation is important. So here's wage inflation. Survey was calling for 0.2%, came in at 0.3%. The prior month was a really, really weak number, but this 0.3 number is showing some wage inflation. And you ask yourself, well, what's the big deal about wage inflation? Why is wage inflation important? Well, wage inflation is important because it's the factor that the Federal Reserve uses before actual inflation shows up at a producer or consumer level to raise interest rates. Now that we had two consecutive good numbers, this number factors in the impact from Brexit. We've had two really good factors two good reports come out. Wage inflation, two good reports. They're going to want to jump back on raising interest rates. There's absolutely no doubt in my mind that you're going to hear from all the pundits, the economists. You're going to hear talk about a September rate hike back on the table, which should cause dollar strength. It should put some pressure on commodities. For anybody that's tuning in live now, the number came in at 255,000 jobs, and the survey, the consensus estimates were 180. We had a 75,000 job beat. Also going back to wage inflation, why it's important. The Federal Reserve uses it as a precursor to raising interest rates. That combined with two strong job reports, June and July. July even, looking at the post-Brexit, data, the Federal Reserve is definitely back on the table right now for a September rate hike. It was a strong report. The numbers were revised up positive, in the previous, from the previous stuff. And it's just, really, really, really interesting, how this number one driver of macroeconomics, the health of the world economy, is actually bucking the trend. There's a lot of countries out there that are not doing so well right now, but that's definitely not the story here in the U.S. The story here in the U.S. is a lot different. The numbers are actually, much, much more positive, much greater than anyone really expected, even, just a couple of weeks ago. And we're going to continue on with this trend. The things that we've been talking about here at Alexandria is we've been pointing out how there's been a ton of weak macroeconomic data, and this weak macroeconomic data has been causing us to pause. And we're waiting for something to refute that view. We have two very, very good job reports. Again, this is the biggest market moving data out there. I'm just gonna show you some euro dollars here, and just let's see how the euro dollar market moved today. It moved in the direction of a rate increase. That's how it moved. The dollar is it's stronger today. There's a much more there's a much greater chance that the Federal Reserve is going to increase here. And I'm going to show you the dollar versus a basket of currencies. Look at that. Look at that. That's a huge move up versus a huge basket of currencies. This is the dollar index. It indicates the general international value of the dollar. And we are going to take a peek at, see, just it's a straight line up. So it's a very positive job report. It means that equity prices here, they should be supported. Commodities are going to be called into question because of this is going to be a strong dollar story. This is going to be a Federal Reserve that is basically going to be back on the rate increase message. A lot of the macroeconomists around the world are going to be talking about when they're going to get back to increasing the increase in interest rates. And this number obviously spells well for inflation. If you're just tuning in now, we got some wage inflation, which is the number one reason why. It's the number one watch signal. It's the precursor to inflation at a producer or a consumer level. So when wages start to move up, the Federal Reserve looks to front run that and raise rates to cool off inflation. Not saying that inflation has been super great or anything like that, but we have two very back-to-back, very positive back-to-back non-farm payroll reports. The June number came in more than expected at 287,000 jobs, and the July number came in much greater than expected, beat by 75,000 jobs, and it's it's at basically 255,000. So this is going to cause a strong dollar, put pressure on commodities, put pressure also on corporate earnings. So equity prices at this level, you have to keep your eye on the dollar, how strong it is, especially in the large cap names that are earning profits overseas. It's very interesting. The yields should get absolutely crushed. We're going to take a look at some of those bonds this morning. As you can tell, see the U.S. Treasury got actually hammered, but we look through Europe, and Europe is the yields are pretty much higher, with the exception being some of the pigs. And it's just today's a really good day for the U.S. economy. It's a really good day for labor and wages, and that should translate. It should reverberate around the world that the Federal Reserve is going to increase interest rates this September. So if you don't think that's a possibility, you're definitely wrong. You need to reconsider that. I'm not saying that it's a good decision, but it'll be the chatter that's coming out this week and moving throughout the next FOMC meeting. So you have to consider this into the equation, and if you don't, you're off. So the next date for rate increase is September 21st. On September 21st, we'll know what the decision is. But I expect, I expect that to be the topic of conversation. Really, the one major driving factor that has implications on everything from commodities to interest rates to equity markets around the world. It has like very strong implications for all of us, and it's something that you should not overlook here. I'm going to show you how some of the futures reacted. That's the Dow. Here's the S&P 500. Here is the Nasdaq. Here is Canada composite, the TSX composite. We see here the dollar. Yeah, it's been a very bullish number this morning. Anyway, I am going to get back to work here. I hope you have a great weekend. Thank you for tuning in live. If you don't follow us on Twitter, please do so. We're at Outsized Return on Twitter. If you don't follow us on Facebook, we have a Facebook channel as well. But expect dollar strength. Expect the conversation of a rate hike September 21st. Expect some pressure on commodity prices. Expect chatter on corporate profits. Expect the conversation about corporate earnings not being so great. And the companies that beat revised down expectations. So expect revenue weakness from the multinational corporations, which is why small and mid cap stocks have been outperforming large cap stocks. So expect these things to come into play. And again, if you don't follow us on Twitter at Outsized Return, and anyway, thank you for coming in, and I hope you have a great day of investing. I hope you have a great weekend. Thank you very much. It's been a pleasure.